Welcome to NASDAQ Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at NASDAQ. Joining me at the market site in Times Square, we have Luke Oliver. He is the head of index investing for the Americas over at the DWS Group. And we're going to take a look at everything within the macro space, including China, currency hedging, the search for yield, and of course, ESG. Luke, it's great to have you with us at market site. And China ETFs, that's really been at the forefront, at least for the past couple of years.
Yeah. Well, certainly. So we've seen China continue to open up to investors, and most recently we've seen a removal of the quota system. So there'll still be the licenses, our QFII licenses out of Hong Kong for accessing China, but the limits on how much you can access China has been reported to go away. So when you add that to the increasing access that you get through Hong Kong Connect, China is rapidly becoming a very open market, which then means that the indexes are going to start adding more and more China. So China becomes a lot more mainstream. And so when we think about that, we think about the A shares, those mainland Chinese stocks. And if you look at those versus the Chinese companies listed in Hong Kong or New York or elsewhere, they've actually performed very well and robustly through this whole trade war, tariffs, volatility. So they've actually done very well versus the Hong Kong.
Are you concerned, though, with the geopolitical environment right now that the access could be cut off?
Well, so the irony is it was always the concern that China didn't give you access. They're giving lots of access. Right. Now the concern is, does the US limit the US's access to China? So I think most likely the continued access to China from the US probably is not stymied too much. I think there might be some oversight more of Chinese companies listed in the US, but generally speaking, especially if you're accessing those A shares I talked about, I don't think we're going to see much impact, and the indices are going to keep adding them.
All right, let's talk about currency hedging, because right now we're seeing that movement this week, especially with the dollar, with the euro, with the pound, with what's happening with Brexit. How do you manage that?
Yeah, well, US rates are still higher than almost everywhere in the developed market. So there's still a bias for the dollar to get stronger. Even if rates come down a little bit in the US, there's still a bias to dollar strengthening, and we've seen that throughout the year. In fact, the last couple of years, the dollar's strengthened considerably. That puts international investments at a disadvantage. So that's why we favor international investing with the currency hedge. That allows you to, and to your question, how do we implement that? We literally take our exposure to, say, EFA or Europe or Japan or whatever market it may be, and on a monthly basis, we go short the currency that those stocks are valued in, so euros, yen, pounds, and we go along the dollar against them with a 1 month forward. That means you still get the stock exposure, but without the currency volatility. And then there's a little secret sauce in there that because rates are higher here, you actually get paid that rate. The difference between euro rates and dollar rates, you get paid when you put on a currency forward. So if you think about currency hedging, why I think more than ever, despite having already seen dollar strength, why I still favor a hedge is that you get paid that carry, which is about 2.3% for the EFA basket. You get a reduced volatility almost in almost every scenario that you have when you currency hedge, and you still get the local exposure. So when the euro weakens, that could be good for European stocks. We still think there's a value to international stocks, and then you reduce the volatility of them, and you earn a carry on top. It's quite an appealing way, especially in these markets where yield is low. Why not earn a yield on top of your international allocation?
And that was the next point I was going to go into, this search for yield, and really, you know, what is happening internationally, and if that's why we're seeing so much money come into the U.S. markets, because where else are you going to get it?
That's right. Yeah, and when that happens, the dollar can strengthen when people are seeking those risk assets. So we've seen two places where we really like to look at yield. One is in the high yield space. If we think that there is not going to be an impending recession, and we think that defaults are going to stay low, why not look at high yield bonds as a way to continue earning that yield? That's not to say that high yield bonds are not without elevated risk versus investment grade, but there's certainly an opportunity there. And another place we've really found interesting more recently is switching away from fixed income towards equities. If you look at international stocks, they tend to be a little cheaper in a valuation perspective versus their US counterparts. So historically, there's been a higher dividend yield. And then when you look at the fact that there are strategies out there, one of which that we manage, we actually don't just look at high dividend stocks, but stocks that have persistent and robust and sustainable high dividends, and look for that very more concentrated view on high dividends. So when you get that, you actually get a dividend yield of something like 5.5% for that EFA basket versus 3.5% for the unfactored version. So there's a real opportunity for international high dividend strategies right now as well.
All right, let's wrap it up with ESG investing and indexing, the growth has been tremendous.
Great growth, and even on that, if I look at something like 4 billion has moved into ETFs in the US with ESG this year, and we've seen about a third to a half of that come into our strategies. And the way we're looking at this is, rather than thematic plays, i.e., I don't know, solar panels or water companies or something like that, we're looking at the big benchmarks, MSCI, S&P, and looking at how we can give access to those broad benchmarks, but in an ESG fashion. So I think that's where the future is. I think there's going to be a core and satellite approach, and that core is what's been missing.
All right, thank you so much, Luke, for joining us at MarketSite.
Thank you.
And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at NASDAQ.